This week, the Bank of Canada dropped its prime lending rate from 5% to 4.75% for the first time in more than 4 years. Who better to explain other than Angelo Melino, University of Toronto economics professor and former special advisor to the Bank of Canada. Angelo, let's get right into it. 0.25% drop. Some say it's a win, others think it's not enough. What are your thoughts?
Well, I would have preferred to see the bank go a little bit sooner. But to be honest, there were good reasons for the bank to wait. There are good arguments on both sides of that equation. Um, I think that the bank is likely to cut a couple more times this year. And if it went a little bit too late, it can cut a little bit quicker. If it went a little bit too soon, it can hold off. If it really missed the boat or jumped the gun, well, we're going to have to need a year or so to find out if that happened.
So who does this benefit then? Investors?
Well, it's a very small change, 25 basis points, a quarter of a point. So it's not going to affect a lot of people very much. But basically, it's going to hurt savers and it's going to help borrowers. And borrowers include most businesses, most households, levels of government, and ironically, the Bank of Canada itself. So I think that the households that will benefit the most include those who are on floating rate mortgages and those who have home equity loans. Won't affect households that are thinking about getting into the housing market very much because although mortgage rates might come down a little bit, that's going to be offset by higher bidding and higher house prices.
Okay. Shifting gears now, let's talk about the latest data from Statistics Canada regarding job numbers. Canada's unemployment rate rose in May despite a gain of 27,000 jobs. How is this possible?
Well, we've been experiencing rapid population growth. Although the federal government has put in place some policies to curb temporary workers and foreign students, we still are seeing population growing very, very rapidly. We probably won't see the effect of those policies until the fall or maybe early 2025. And in the interim, with a lot of population growth, you need a lot of jobs to keep the unemployment rate down. And although employment looks healthy by historical standards, it's not enough to absorb all the workers that are in the economy now.
Okay. And how do these numbers tie into the Bank of Canada's interest rate? Because the Bank of Canada said earlier this week that it will be watching the rate of pay hikes as it determines the pace of future cuts.
That's right. The Bank of Canada, unlike the Federal Reserve Bank, doesn't have a dual mandate. It has one focus, and that's inflation alone. But in practice, it's not all that different because there are important links between what's going on in the labor market and what's happening to the path of inflation. So we've seen a lot of weakness in the labor market. We've seen unemployment rates going up. We've seen vacancy rates coming down. So the quantity side of the labor market is certainly showing signs of weakness, but wages have been stubbornly high relative to both inflation and productivity. And that's something that the Bank of Canada is going to be looking at and giving it some concern. I don't think it's enough to stop the bank from moving ahead in cutting the path of the policy rate, but it will be something that it watches along with other things like inflation expectations and corporate pricing behavior. The bank gave us a small laundry list of things to keep an eye on.
Okay. Any predictions for July's Bank of Canada announcement?
Well, I think unless we have a couple more important reports between now and then, but unless we get a surprising uptick in inflation, I would expect the bank to cut one more time.
Okay. Angelo, thank you for your insight. That's University of Toronto economics professor Angelo Melino.